All right, so it's 2 o'clock, and I'd like to welcome everyone to the second public market webinar. Today, they'll be focusing on global investing. Our guest today is Jean-David Meloche, who is Montrusco Bolton US global and global ex-fossil fuel portfolio manager. Jean-David and his team has been managing the fund since 2009. As of March 31st, and you'll see the slide on the screen, our global equity fund was ranked first quartile on a year-to-date 1, 3, 5, and 10 years term. Actually, I forgot 2. So over all terms, we've been ranked first quartile by eVestment. Just below, you'll see a subset of our global fund. The ex-fossil fuel has been launched just under 2 years ago, and as well has been ranked first quartile. So Jean-David, thank you for being here.
Thanks for having me. Thanks for setting this up.
You bet. All right, so I'll start with the first question. So since you've been managing our global equity fund, so that's more or less 11 plus years, the average annual excess return has been over 4%. But just year to date, you are ahead of the benchmark by more than 10%. How do you explain that?
I love having to explain that. So obviously more than we budget for. We usually aim for 200 to 300 bips of added value. And this year has been exceptional. The start to the year was just awesome. 2 things helped, and pretty much in equal parts. Our mainstay is really stock picking. It's really finding mispriced assets, invest in them, and take profits when we need to. But in the first quarter of this year, just stock picking delivered 500 bips of alpha. And it's really the environment. It's a very volatile environment with compounding uncertainties and a lot of market moodiness. And so finding mispriced investment opportunities is easier. We have stocks that have moved so quickly, reaching their target price. We book profits, we take it down to a minimum weight, and we reinvest. So the process remains the same, but the environment is really giving us a lot of opportunity to add value just from stock picking. And second, we have style biases in our portfolio. So if you think about quality and growth, both did really well in different parts of the first quarter. If you recall, the really strong markets at the start of the year until about mid-Feb, the growth bias really helped us out. The growth company were roaring ahead, and we very much benefited. And then if you go to the peak of the fear from mid-Feb to mid-March, quality was doing well. Survivability was really valued. So if you think our quality as defined as low debt loads, high profit margins, the market was really hungry for that. And so these style biases that are constant through time really paid off. So half the alpha coming from stock picking, half the alpha coming from our style bias.
Thank you. Great. Well done. Can you broaden out and explain what type of stocks you look at and what is changing with the new world out there?
Fair. So first, we look at stocks from a bottom-up perspective. We're not top-down driven by any means. We assemble a concentrated portfolio of 35 names. And so I talked about the type of stocks. I talked about quality. I talked about growth. And the process really isn't changing. It's not market dependent. We always consider upside scenarios, downside scenarios, different forecasted P&Ls, different valuation methods. So in good times, we think of bad times and we prepare for them. And then when the market is really pessimistic in terms of market psychology, we think about rebounds and we think about opportunities. So being able to always look at different scenarios really helps us when the market transitions from one mood to another. And that really isn't changing, but it is paying off these days. So if currently with the changes in the world, you can say, our base case scenario for a lot of very sensitive stocks is the unfolding Cold War, if we can call that already, between the US and China. So the process doesn't change, but our focus changes. The supply chains we're very familiar with. As soon as the trade wars started, we're familiar with the flexibility that each company can have in terms of redistributing its supply. The question remains, what's the marginal impact? If you're producing in China, it's because of scale benefits, it's cost benefits. The companies tell us, and we ask, of course, all of the companies that we look at, we can move to Vietnam, we can onshore in the US, we can move back to Europe. The question that they're less comfortable with, because of course we're not there yet, it's the impact on the margin. There's a reason you're in China. If you have to move, it's great. We want you to have that flexibility. Where we're spending a lot of time in our modeling is, what's the cost attached to this? Something that our process is pushing us towards these days as well is the value of Western brands in China. Will we have, every time the relationship heats up, you wonder about the success of Western brands. I remember a time where there was a bit of a heating up in the relationship. This was a time where we owned Yum brands, so think Pizza Huts, and there was a reaction. There's this nationalism that we see in the U.S. and China that does affect the consumer, and so we're certainly considering that currently in our scenarios. So types of stocks we look at: quality, growth, always. Our process isn't changing. What we focus on, what we brainstorm on, the things that we're stress testing changes with the times.
Okay, I got one here. So you've been mentioning quality stocks. So everyone seems to be looking to buy quality. So we rarely hear, a portfolio manager say, "Oh no, I'm really looking for a trash stock," if I can use the word. How can you generate alpha by looking at what a lot of people look at, that is quality?
So we don't invest in quality because it's pretty. It's not a question of it sounding good or it being comforting. We're not looking at brand names because people know the products. We focus on quality because it's just an enabler in our investment process, and it's the investment process that generates alpha. So the quality focus helps streamline our investment process. We invest for the long term, and we're doing a lot of fundamental work. We're forecasting out 3 years, quarterly. We're looking for inflection points. We're looking for optionality. In the end, we're looking for mispriced assets, right? But we only focus on quality companies because there is already so much uncertainty. It's already rather pretentious forecasting 3 years out. We absolutely have to focus on companies that don't have to reinvent themselves with every new product launch. We have to focus on companies that have staying power, that have barriers to entry, that have brand, that have recognition, that have solid value chains. We always talk to suppliers, we talk to clients, we want to understand the whole ecosystem and how the margins are evolving through time. So we need companies with great disclosure. We need companies with very low leverage, the clean balance sheet. It's not because it's pretty. It's because when we think about the upside scenario versus a downside scenario, in a downside scenario where a company already has masses of debt, when we're looking at, a drop in revenue, then we have a risk of financial distress. We don't have the skill set to value a downside on a liquidation scenario. We're not looking for it either. So since we're not adding value on that scenario, we're just not looking at this type of company. So clean balance sheets, no risk of financial distress, strong barriers to entry, good communication. We need good disclosure. We need access to the management teams to be able to dig into what we need to. So it's not because it's pretty, and I get why a lot of people mention it. It's really because it strengthens our process and helps us take risks where we mean to.
All right. If you go at the company level, can you give us an example of companies in your portfolio or stock that should do well in a post-COVID environment?
Sure. We have a number of them, and some of them have outperformed, and we think they have still great fuel left in the tank. A post-COVID environment, so if we're thinking about longer term changes to habits, a few are obvious. And I'm not going to teach you anything, but greater use of cloud for the long term. So you think we have in our global portfolio Amazon, Microsoft, Google, all the cloud players. We have derivative plays like Adobe where you think of working from home, where you think of more cloud usage. Adobe is a clear winner. This is a recent add this year to our portfolio, especially when we started recognizing this trend. And then you can think of a Dutch company called ASML that we've owned for a number of years. They are very much geared to what's currently coming out, the new smaller nanometers tools. The smaller chips, they're cutting edge, and we've been looking at it for years. We deployed, and we think this environment of increased need of computing power, these stocks are not yet overpriced. We still have great upside, even though a lot of them have outperformed. There are tons of things that we see that we can invest in. If you think about, say, higher hygiene standards, fairly common idea. People are looking at disinfectants, sanitizers. There are some great companies that do this. They're not mispriced. People are thinking that Purell will stay sky high in terms of sales forever. You have so many companies also entering this space, trying to reinvent themselves in things that are hot. The barriers to entry aren't strong. This isn't a trend that we can play with. If you think of changes to transportation, so midterm, people avoiding public transportation, people perhaps avoiding even sharing cars with people they don't know. We're looking at business models, and we're not deployed yet. We're looking at an emerging market company that focuses on leasing cards, which is not a great business these days. You've seen what happened to Hertz, and we're sort of thinking at whether they could build a car sharing platform. So interacting with them, this isn't guidance they're giving. They have these assets. Demand is weak. So we're thinking about building an investment thesis about a shift in their business model, and therefore a shift in their valuation and consensus expectations. So these are things we're doing. I'll give you one last example. Netflix, the darling, right? Everyone thought immediately subscriber growth. I became a subscriber, never had Netflix before. I'm usually a late entrant into new things. And these these new subs are sticky, right? It's not a question of I'm loading up on toilet paper. And then when you look at how this stock has been trading in the first quarter, if I go back a week and a half, maybe 2 weeks ago, this stock had outperformed the broader US market by 55%. I can tell you we held a very small name in that weight, a very small weight in that stock at that point. Today, or actually yesterday when I looked at it, the outperformance was down to 25, 30%. We currently own a higher weight. So I was talking about the markets shifting really quickly and giving us great opportunities to add value just from pure stock picking. Netflix is a great example of a stock moving a lot, allowing us to book profits when it gets ahead of itself, and then reinvest when we see an opportunity.
That's very clear. Just for the audience, if ever anybody wants to ask any question, you can always do that in the Q&A box. We can accept your question in advance, so don't hesitate. If you want to send a few questions, we will address them once we're done with Jean-David. So let me go to the next question. So of course, when you speak to management of the companies, of public companies you invest in or consider investing in, what are the most common things that keep them up at night?
Yeah, we talk to companies all the time. Those we invest in, obviously, those we're considering, even different parts of the supply chain. We love talking to suppliers of companies we're looking at. We love talking to clients of companies that we look at. We want to grasp the whole value chain. In recent days, so for a few months, we've been looking at a consulting firm. They're based in the US, and they have this interesting business model where they do consulting on large cross-border M&A deals. So very pro-cyclical in terms of business. And then they have a business that does workouts of bad debts. And we've been talking to them quite often because we're always getting different feels as to how the market's doing. It's changing so quickly, and what the governments are doing is shifting so rapidly. So we spoke to them in the last few days, telling them, say we're running with a scenario of a far more regionalized world here. Do you think that the added value, that the return on capital that you get from a large M&A cross-border deal, the juiciest thing, the things you guys work on, do these companies, do you expect as much volume? Does the scale benefit? Does the local presence? Does the global supply chain? Does being in all geographies and diversifying in these different markets? When you're looking at the deals that you were working on, are they going cold? Are people fearing the regionalization of the world from an M&A perspective, and therefore, I guess in a way that's not the way we frame it when we talk to them, but say reducing your potential revenue growth? And then we started worrying at the same time on the counter-cyclical aspect of the debt workout business with, like, what are we up to? We're up to 10 trillion of government support. We're already ahead of every government support measure that was in place in 2008, 2009, and we're not done. This is 5% of GDP. And we're looking at debt workouts, and there's so much support. Are there going to be masses of very profitable debt workout jobs coming your way? Is the support really hampering your business? Or if you think of workouts, or if you think, perhaps the governments at one point say, this is the limit. Yes, unemployment is 20%. A lot of people can't pay their mortgage anymore. Will that lead to workouts as it did way back when? Will the person who, through no fault of his own, default on his mortgage, will he mail the keys as some people did when they were speculating in 2008, 2009? We don't think so. So when we're looking at that debt workout, we're thinking there's a need for some form of social peace, and just our estimates on that business has gone down. So that was one interesting discussion. We're looking at and stop me when I'm boring you, because I'm going to go through different business models. A company that makes professional equipment for outdoor work. We don't own it yet, so we're talking with the management team, and we know that people are going to spend more time at home. They're not going to go on that cruise, so at the margin, they're going to spruce up their surroundings. And we're looking at companies that aren't overly excessive, where it's not the go-to. And this management team, what they're worried about, it's really the ability of their client to pay for the new improvements. So they're adding bells and whistles to their outdoor equipment. So for the contractor work, they don't mind. The contractors don't need the bells and whistles. But what they sell through the likes of Home Depot, they R&D, they try to increase pricing 4 or 5% a year. We love that. We're growth investors. But the management's freaking out as to, should we hold back our initiatives, our new bells and whistles, and keep them for next year, because we fear that people might not pay up for them. We're talking with an emerging market grocer. So their business is humming, right? They're grocers, everything looks good. It's also, there's sectoral rotation, people are hiding in their dividend. And when we talk to them, what they're currently worried about is they're so profitable, and this is an emerging market. They worry about their future tax rates. Is it going up? Can't guide for it or anything, but therefore they worry about it, and we worry about it too. We spoke in the last few days with a European ingredient company. So they make ingredients that then the big food manufacturers use in their branded products. And the worry of the ingredient manufacturer, so somewhere up in the value chain as a supplier, is the loss of impulse buying as people order more online, as people don't go out as much. And of course, impulse buying is great for launching new products. It's great for margins. So they worry that their clients, the branded food manufacturers, sort of reduce the R&D, reduce the innovation in the new product, and therefore fewer contracts for them and fewer new molecules, fewer new flavors that they can come up with. That's the worry that they have. We've talked with a pet health company. And of course, pet health, your companion is very countercyclical. It's a very sticky business, not as much as food, but a very good business model. We're looking into this. We don't currently own this company. What they worry about is, how often will the person take the pet to the vet? Is that going to go down? And so does that reduce their volume? And then if it's bought online or if it's bought on a regular basis, that pricing power that comes from the impulse buying, you're at a pet shop or you're at the vet, you see it, oh, why not? Due for another flea treatment or whatnot. So these are types of worries that we come across, and that we, of course, embed in our risks and opportunities.
All right. Let's go to ESG investing. It's very much in demand. People are looking to be more sensible and conscious when they invest. And so we've been using ESG as a guiding principle in most of our strategy. But let me ask you, in your funds, how do you incorporate these principles into your investment portfolios?
Yep. So nothing new for us there. At Montrusco, we've been committed to ESG since 2004. So again, this has been, it's not because it's new and it's hot. I actually remember a roadshow in the US, and a financial advisor asking me, I think his exact wording was, how much financial return are you leaving on the table to be a tree hugger? And I'm hoping that his viewpoint would be different now. But if we go back to 2004, our approach was really exclusion based. So think gambling, think military hardware. It was really, okay, we're not touching this. And over the years, we've really developed the approach by incorporating sustainability goals, positive filters, positive engagement with the management teams to just enhance the sustainability of the business model through goals on gender equality, CO2. And you mentioned our average annual returns. Obviously, we're not leaving money on the table. If anything, we're just focusing on better sustainability, better barriers to entry for different business models. So we now measure ours and the benchmark in terms of non-financial performance. So everyone's used to all of our statistics, all of our alpha information ratios, standard deviation, net debt to EBITDA. But we've recently brought forward all of these non-financial performance that increasingly investors care about, and that is not costing us alpha. So the types of indications that we would put in non-financial reporting would be measures of bribery risk. You can benchmark this. And of course, carbon risk exposure and basic CO2 footprint, water initiatives in terms of water usage per dollar of revenues, energy usage, types of energy. So all of this we've been measuring, and we always act as a partner. It's not a question of shaming a management team. It's a question of engaging, showing that we care, and often perhaps giving examples. So a lot of companies say, I'm the smallest company in our portfolio is about 6 billion USD. And they say, at our size, we're not going to hire people just to do this. And so we can explain to them how you can benchmark these things. You don't need to send someone to each of your locations to calculate the electricity bill, see in the state where the electricity is coming from. So it's easier than companies think, and we see ourselves as partners in helping them start by measuring the footprint that they have before we move to improving it.
Yeah, but Jean-David, everybody says that they care. So, what is so different in your approach, if I can say, when considering ESG in your standards? Basically, your standard you're using as ESG.
Nice, you're provoking me. Listen, for the last 4 years, we've exited investments based purely on ESG considerations. So just failing an ESG check in our monitoring process. So we get together. We can't stomach this company. This is the due diligence we have with the company. No hope left. They're not returning our calls quite often. So if you take one company per year, that's about 15% of our total name turnover. We're long-term investors, right? So if you say on average we own a company for 5 years, so call it 15% of our total turnover. So we walk the talk. We will exit companies, nothing to do with their financial return, just from an ESG, from a sustainability. We can no longer own this company. They're just not engaged. They're not looking to be sustainable, and we're not sacrificing performance to do it. And then I guess also to prove we walk the talk, all of our interactions with management teams will have some form of sustainability, be it sustainable goals, be it just basic ESG criteria. A lot of them is just pushing them to measure more. This was the first thing that we thought we could engage with management teams. And then it's just, sharing how we care, how we view things. And all of these interactions we have with management teams, we keep traces. So all the calls that we have, if you're a client of ours and you have trouble sleeping, happy to share extracts from our conference calls.
Yeah, I'm sure a lot of people will call you on that. But no, I really like what you're saying about having self-disciplined as it comes to ESG. I think that's the best way to prove that we're ESG. All right, so I'll switch gear here, and so performance is one thing, but I'd like you to tell us how do you protect capital?
By a number of ways. One, I come back to the quality aspect of the portfolio. So individually, each of our investments has, in our view, limited downside, or a downside that we can encompass, that really fits into our process and the skill set that we are applying to this investment. So low debt, high margins, high barrier to entry, good visibility. That is one way, just idea by idea, to help limit downside. And just our attention to balance sheets. We've never owned a company that fell into financial distress. Can't say it's never going to happen, but we work hard at it. The last 11 years never happened. Also, I'd say we don't take market risk. So if you're looking to outperform over the long term, you could say, well, I'll just take more risk. The markets are fairly efficient. They reward risk with excess return. So say I carry more market risk, a beta. If I carry a beta of 1.5 over a period of 11 years, probably I'll outperform. We don't take market risk. It really streamlines what we have to worry about. We worry about everything. We're all very paranoid on the team. So market risk is not a type of risk that we take. We take operational risk. We take bottom-up, fundamental business model risk. But at the aggregate level, we make sure that we have low beta countercyclical names, very growthy names that do well in good markets. And this has allowed us really to outperform in both years of negative markets. Actually, if you include this year, so if you take, there are 3 years in the last 11 where certainly year to date, we're having a negative return. We've outperformed in all 3 years where the market had negative return. And this comes from, some years quality growth doesn't pay off. Some years there's a negative return. The fact that we're always focused on stock selection, on added value, even when either our stop buys doesn't pay off or when the market's negative, this really supports the total return that we deliver on our product. And then I guess another way to protect capital, more on a quantitative side, we stress test our portfolio through a number of quantitative screens and stress tests, and not just the value at risk and making sure you have just the right amount of risk for your hoped for added value, and then making sure that it's not overly concentrated in fewer positions. So that's obviously something that we do, but we consider our sensitivity to a number of macro factors, inflation, and then the level and the shape of the yield curve, the price of oil. We want to make sure that as we focus on selection and grabbing all of these great mispriced ideas that we have and building them into a diversified portfolio, we don't want that at the aggregate portfolio level there develops an unwanted sensitivity to the barrel of oil that, we all like our ideas, but it just so happened that they were all really sensitive to oil going up and oil's going down, and therefore this completely overwhelms all the work that we've been doing. So we take risks where we add value, and we measure these other risks and make sure that they don't negate the value that we're trying to add, and therefore we also protect capital, I think, that way. If that answers your question.
Yeah, it does. But I have this another angle I'd like to explore, and it's the concept of growth versus value. So growth has outperformed value for many years now, and some people might be wondering, are we set for a reversal?
Yeah, I could wonder that myself. So growth has certainly outperformed value, and actually one of the years where we had so in last 11 there were 2 years where actually we did not beat the market, and one of them we had positive selection effect, but growth was just not in favor, and that happens. I remember someone called it crap runs in that year, and that can hit our portfolio. So I believe growth remains a very good bias to hold over the long term. We've seen the last 10 years, very few times did it go out of favor. I'm sure it'll happen again. But again, so even I think in most year growth will outperform. I'm sure there will be years where it won't be helpful, and value and deep value will do well. But if you remember, the majority of our added value comes from stock picking. and that's fairly agnostic to the environment. We're not married to a growth environment when, even though we have a growth bias, we don't have just one scenario of blue skies. We don't believe in blue skies. We're optimistic, obviously. We have a growth bias, but we're paranoid about risks and what can happen to the portfolios as a whole, but also each idea. And so I think growth will keep outperforming over the mid-long term. I'm not going to call out years, but I like that the main engine that's running our alpha is stock selection.
I can vouch for that. I know it's true. You don't get
paranoid.
Excuse me.
I can say that.
No, that's not what I meant. I just said that I think you have strong belief in. You do your very good due diligence on your companies, and you.
I have a great team.
Yeah. It's been 30 minutes already. There's a few questions that came up. I don't know if you want to bring another topic, or do you want to go and jump to Q&A?
I'm good for Q&A.
All right, good enough. We'll look it up. So let's start with the first one here. So the question is, many tech companies fit the ESG criteria perfectly. And with large inflows in passive ESG thematic funds, do you think that this trend for tech companies is getting overstretched?
I'm sorry, I'm going to ask you to repeat that.
Yeah, so the fact is that many tech companies fit the ESG criteria perfectly. So there is a lot of the inflows going into passive ESG thematic funds. So that trend has been fueling tech companies' prices, like share price, to go up. Did that have a material impact? And did it push the pricing, the valuation in overstretched territory?
That's a great question, and I'd love to know the answer. I don't think I do. One thing, if the angle is, do our investments in tech, have they been sort of overblown with I guess excess demand for ESG, for pretty ESG names? So off the bat, so we don't take sectoral deviation. So we have the IT fairly similar to that at the index. I mean, I noticed that some stocks that are market darlings that score extremely well on Sustainalytics, on Robeco. I've noticed that so usually what happened, I'll take the example of Total, a French energy company that scores something like 98 on Sustainalytics. There was a period where, and Sustainalytics, the way they score, you're heavily penalized when you disclose nothing. You get a worse score if you disclose a terrible number than if you just don't disclose any. So smaller market caps are usually penalized in that, that just haven't been as quick in generating in just providing information. And I noticed that as Total was, pulling out all the stops and investing a large amount of money in ESG, in sustainability, they hired someone that had a great reputation, gave him, I believe, a board level sustainability officer seat, and they reached 98%. In my view, with my focus on history and on products, we don't default to Sustainalytics score, but I have noticed that a number of companies, and Total is the one that comes to mind, when they have, shaken up and really looked at how they get rated and really, dot all the I's and take care of the T's, they have gotten a premium valuation. But for the tech sector as a whole, I couldn't say. I apologize.
All right, that's good. That's good enough. So the next one is, every time there's an announcement on a new drug or vaccine, we see a big rally in the markets, and specifically companies most impacted by the confinement, among them big banks. How do you position yourself given these trends, and is growth likely to lag quality value?
So to that last part, no. We noticed the same thing, and we're actually benefiting from at some point when we talk about the moodiness of the market. The market is very focused on COVID, on numbers, and obviously on support. So banks are currently trading. You've probably seen the papers of the curve targeting that the Fed could manage, just making sure that there's an upward sloping curve so that banks can make a NIM and therefore take care of the bad debt that comes their way. It's going to be interesting times. Those are massive types of guarantees that the governments are putting forth, and we always doubt that the market will always believe them. The market's always asking for more. So yes, as soon as there's good COVID news, vaccine, lower death count, we and this has given us, as I mentioned, great opportunity. So we're looking a bit beyond. So is the market. So the market is currently, you see the valuations, they're looking beyond COVID. I would say they're even looking beyond 2021 and the numbers that should come out in the recession that we'll see worldwide. Anchoring, if you look at the multiples on 2022, they're sometimes a bit high, but of course the rates are so low that it kind of makes sense to have higher multiples. What we bank on and the way we approach this is the market mood shifts. And when the market is really convinced that there won't be a double dip, that the government guarantees will pan out, the market's going to shift. The mood is going to be unstable. If like, we don't even need to call the when. So I was talking about in the first quarter, but also last year's, in many years, market is moody and it's like, is very short-sighted. And sometimes, as soon as they look beyond, then the mood changes. And I think that's where I think the market is going to move next. It's going to focus more on recessions and on how to pay for this debt, and is this even enough, and is COVID here to stay? So we don't make alpha from big market calls. Yeah. But to your question, just so I don't dodge it, we think there is a bit of complacency, which is exactly what governments want, and you saw Europe yesterday, you saw Japan yesterday. There's of course a limit, and I'm not sure that the limit in terms of what the market demands, I don't think there's a limit to that. And I think yes, I think a bit of pessimism is probably our next step from here.
Thank you. Funny enough, the two first question were two of the sectors that comes to mind: healthcare and technology. They seem to be the darling of or the place to be right now. Just a little comment here. Next one. Do you worry about high carbon footprint when selecting companies with large return potential?
We do, and we engage with the companies. So of course not an issue. Well, and when we say carbon, I'm not just thinking about energy, right? It's just a relatively high carbon footprint for a given company. We do worry about it, but we're also not trying to prune and not trying to make our fund, statistically in our non-financial reporting. We're not necessarily looking to make it that pretty. Could make sense on a marketing basis. But I'll give you an example, because our recent examples haven't been with a carbon footprint. We're looking at a company that buys a lot of produce from Africa, and what they buy involves child labor. And I don't mean the child labor definition that some might have, that you're under 18 and you're working, like the ILO, the International Labor Organization definition, where this harms the child's development potential, like a much harsher definition. And so at first we were looking at this company and we're saying, can't touch this with a 10-foot pole. Child labor, can you imagine? And then we started discussing. We had a call with the head of fair trade here in Canada, and talking to different NGOs and different people who knew more about this than we did. So steep learning curve, and we kind of liked the fact that yes, they're invested in very poor nations with low corruption level on a relative basis. We wouldn't, investing in poor countries and supporting that is good. If it's a very corrupt environment, it's just we're not going to do that. But these are in low corruption countries, and this company is upfront. Yes, I mean it's cultural thing. If you grow up in Indonesia and you're not going to school, the neighbors will notice and your family will be shamed. In some African countries, not the case. There's just a need for everyone to work. There's just a minimum family revenue that's required. And this company is stuck. I mean, they could move their production to other countries where yields are higher and efficiency is higher, but their view is kind of support us in this. We're trying everything we can to work with the government, whose responsibility in the end this is, work with the local culture, with the local communities. We tried different things. We tried building schools, and at one point, the school just failed because in the end we're not providing the teachers. They tried so many things, and we're still discussing with them, and we're still not convinced by their spiel. But we kind of like the aspect of, yes, they're facing this problem and they're working family by family, not by a silly approach. One of their peers just sent informative text to village elders. No, we don't buy that. But working with families to understand, okay, the child isn't going to school because he doesn't have a uniform. We can do that. Running a school is not really, we failed at that. But providing a uniform, we can do that. So as a parallel to your question on CO2, we could look at a company that has a heavy footprint. If we believe that they're really looking, if we believe their policies, if there's a serious upper echelon, if it's in their KPIs as well, that helps. So no, we're ready to accompany a company. And I'll give you another example of a company where we thought they were improving, and it's a company we sold last year. At one point, I think 2 years ago, we're looking at Tyson. More people know Tyson now. So Tyson Foods, it does about 2/3 of the meat protein in North America. So they grow beef and they grow pork. And it's a dirty business, a commodity business. We looked at it, it was trading at something like 10 times earnings. We're not into, like I've been talking to you about quality for so long. We're not into commodity businesses where, who knows what happens and where the price goes and the margins are thin. And labor is just mistreated. We know that more now, but with this industry, we looked at it a few years ago. And we were talking with them, and they were saying, no, we're hiring a sustainability officer. We've made an acquisition that turns our business more into a Hillshire Brands, if you're familiar. So they're moving from a commodity to a much higher margin prepared food, perhaps branded, perhaps white labeled. But this was a commodity player, vertically integrated upwards, and we liked that story. We like thinking this could be a 14-turn company, and the company is engaged, like they care. It's still family controlled, but in all our discussions, we believe it. So we do our due diligence. We invest in the company. So happens that the company has done amazingly well. But when we sold it, when the company wasn't returning our calls, the sustainability officer that they named was the grandson of the founder, something the third. And just nothing being done, and just going back to base protein, letting go of moving up market. And of course, in branded products, you have more pressure from clients because then your brand has to resonate and it gets reviewed. So that was one example where we invested in something that wasn't looking good. We thought, one, it would be a great ESG potential, and we'd accompany them in this, and it would be a great financial return at the same time. And that is one example where we realized that the company was not serious about this. It was just lip service. At one point, they stopped returning our calls. We exited.
AJ, thank you. Very passionate when you answer your questions, but they're questions, they keep on coming. So I'll just try to formulate as much questions as possible.
Do this.
Yeah, I'll do that for you. All right. Question here. Has the portfolio rotation turnover increased since the pandemic started in your portfolio?
It has. Normal name turnover would be 15, 20%. The name turnover has increased to 25%, 30%. If you annualize the first quarter of this year, it's a bit higher than that. And then dollar turnover. So of course, our team manages $1.5 billion, and we invest in large liquid companies. So moving money is not an issue. And we are long-term investors, but we're looking for catalysts. We're looking for inflection points. So at one point, you had this great company. Your investment thesis panned out. You have to move to another great company that's also a good investment. And so we do have name turnover. We will, we have forecasts for all quarters. If we think the stock is going to get run over by a truck when they report their quarter, we'll cut the weight in half. And of course we are right a bit more often than we're wrong. We're always stress test that. We don't trade just to trade. There's always an absolute cost to trading. But in this environment where we had massive alpha this year, we've been running with great alpha recently, and we don't want to suffer from mean reversion. We don't want to hold to the portfolio, it massively outperforms, and then the market mood changes and you give back your performance. We want to retain the performance that we have. We book profits aggressively, and when there's 3% upside, 0% upside, minus 3% upside in your base case, and you have another idea that's gives you 20, 25 with limited downside, we take those. So we will trade, and we will switch names. We're not traders. The average holding period remains high. And we do try to limit. We only trade where we think it's material. But in this environment where a lot of our investment theses are panning out very quickly, or if you take Netflix, I mean, it is one stock that we've traded it quite a bit. We always backtest to make sure that our trading is adding value. So trading is higher because there's more volatility in the markets and because we're delivering a lot more alpha. If you think of a market where it's a very broad market and low volatility and every stock is going up by 0.1% per day, we won't be trading much. And it's probably a market environment where we won't be adding as much value as we are now.
Thank you, JD. Next question. Let's try to keep them just slightly shorter because there's just an immense number of questions coming in here. In today's market environment, should Canadian investors be limiting their global exposure?
No, I would think quite the reverse. So when I think of a global equity fund, even versus a U.S. equity fund, and I think of high levels of uncertainty and going into a new world, it's funny because when you look at the news, you can get the impression that the world's a very dangerous place and it's so chaotic out there. But of course, we're not an island, and we have our own issues in Canada. So what I like about a global fund, even versus a pure U.S. fund, is one, we need the breadth of sectors. So if you have healthcare and IT and communication services, it really helps, in this type of pandemic, certainly, and potentially in a recessionary environment as well. So I want to make sure that we have a breadth of sectors. And then different countries, different currencies, different legal environments, different debt loads for different countries, different types of social tissue. Everyone's talking about the Japanification of the world, and I hate that term. No one could have lived with Japan with the policies that they have, the social tissues in America, or, never mind the European Union. Japan has a very solid social tissue where they didn't need that much priming because they weren't facing social unrest. There are a lot of areas that will face social unrest, way before what happened to Japan, and therefore, the European Union certainly feels it needs to act. So I like that diversification. Even at one point, there will be a good time to invest in emerging markets. Not the time for us. We have the ability in our two global equity funds to invest in emerging markets. I certainly don't think we're there now. But we are right now looking at a number of ideas. I was talking to you about the rental company, but we are always looking forward, always looking at different opportunities. And I'll make my answer shorter. You're right.
Yes.
So I think investing, getting global exposure is even better in such an uncertain environment.
Thank you. Anyways, there's a lot of sectors that are just not available in the Canadian landscape. So by going global, you access to industries that are not available within the Canadian market. So the next one is, what central bank policy do you see happening over the near future, and what do you think this could mean for market? It's more macro, right?
Yeah, and there's some economists that I love and respect and love reading. I'm not one of them, but of course, we have to remain in a very low rate environment for the foreseeable future. Some countries have been clearer in terms of their willingness to print, but even those that haven't been clear, I mean, the level of support, the level of debt that we're talking about, and the fact that we're still in a very deflationary mode will imply monetizing, printing, just sort of a modern monetary theory. So I guess to link it with what we have. So, and the governments will have to work hard at currencies. They'll have to, when I say governments, say central banks, they'll have to work hard also at yield curve. So just targeting an upward sloping yield curve and just making sure that they don't get tested on it. So that's my view. We currently don't own any large U.S. banks in the global portfolio. We own one bank. It's an Asian bank. So we like totally see the need for what the governments are doing. I just worry about blips in the market's faith in the tools that are being proposed.
Thank you. All right, so another question, interesting here. So what channels do you use to generate new ideas, given that you have a very large universe, the global universe? How do you?
My favorite is just when you talk to a management team. So when we have a management team, just I love interviewing management teams. And one of the first questions I'd ask a CEO or a CFO is, who's your supplier that he's increasing pricing on you, even in an era of limited pricing power? What does he have that you need? And that'll give us ideas. And CFOs continue to tell us that no one asks them this. We always ask them, so who's this client that you have where you're giving favorable financing terms, whatever, because you like that channel. You see that channel as a great avenue for your growth. So this type of reference from a management team, not a reference in terms of, oh, I really like that stock, but more a link, because of course we're always looking at the whole value chain. So my favorite way to find new ideas is just a management team talking about trends in a certain value chain that can go across sectors, of course. And I like those references. That's a good place to start. But apart from that, we go meet companies, we go visit stores, less so these days. And we go to conferences. We have a lot of quantitative screening tools. And mind you, our ESG sustainable focus, our quality bias, our growth bias, massively reduces the actual investable universe for us. So if you think of, 70,000 primary listings, the universe that we actually play with is around 400 names.
Thank you. Yeah, that was my question. Thank you. All right, so can you elaborate further on how the shorter term you're managing to protect from the downside? Hold on, I'm just trying to read here. I guess it's what are you doing in the shorter term to moderate volatility, let's say over the next 12 months. So near term action you're doing to protect the portfolio, if I get it right.
Okay. This is really something our process kind of takes care of. So the way we work is not changing. We always, so the way the team works, and maybe that'll give you an answer. We're not shying away. We're not carrying a beta of 0.8 in the portfolio. We're not carrying cash in the portfolio. People that invest in our funds, if they wanted to hold cash, they'd hold cash. Cash for us is just a residual to our trading process. So if I get the question right, because I guess you heard from my tone that I'm very bullish on this environment in terms of our ability to generate alpha, but perhaps not so much in the total return on a short to mid-term, in a question of months or quarters. So the way we consider these risks doesn't change. We always have, and we're just working with our base case from which we drive our base case P&L for all our corporations has very comparable drivers. We aim for that so that we can make sure that we have the right weights and the right ideas. Right. And then our downside evaluations remain. The stress tests become very harsh, and we actually question our tools themselves. Sometimes if you're using a VAR with a decay rate, that means that we overweight really the very short-term impacts on the value at risk. I guess sometimes the correlation matrix goes haywire, and we keep track, and we always also use our tools not as absolutes. All these tools are valuable, and that's one way where we see that short-term volatility. We make sure that we look at different tools. We don't look just at that 2-year beta because, of course, the coefficients aren't stable through time. We look at that 6-month beta when we were thinking about our sensitivity to just market risk.
Thank you. There's about 5 minutes left, and there's 5 questions. So we'll try to be very. Thanks, JD. I know you're passionate, so it's great. Continue to be the way you are. You're doing well. What's your rationale for having a concentrated portfolio? Because how many stocks do you own in your portfolio? 35, 36, something like this?
Yep. So the rationale is actually we own as many names as we need to get rid of risks we don't aim to take. If we could do this with 25 names, we could try that out, but we can't. So we try to, we want the portfolio to answer to our stock picking, our business model bets. We don't want the portfolio to swing around with factors where it's not where we're spending our time. It's not where we've built the expertise. So when we're looking at the number of names that we need to be in different subsectors, you might have a subsector it's only a 4% weight of the benchmark, but it's so very volatile that if you're not there, you can get killed in a given year. We find good ideas in that subsector as well. So we need a certain number of names. Then we've never needed an overlay, a currency overlay. We're not we forecast all currencies because they're inputs, such as most macro drivers, into our models. But we're not trying to make a bet. I'm not here to tell you, oh, the pound is completely misunderstood and it's going, to the sky. No. So we want to find ideas in pounds, in euros, in different currencies, and then we need a certain number of names to get rid of other risks. So I would even say that we need a certain number of names to manage the upside, to get the diversification, and we would leave some ideas, some great ideas on the side, just to make sure that we're not taking risks that we don't aim to take. So I found that 35 is a good name, is a good number, and that's just why we're at 35.
Thank you. A question here from someone who asked us if you could answer the question in French. So we have French and English speaker on the call, and the question is, est-ce que votre façon de travailler en télétravail a affecté votre dynamique d'équipe? So did having to work remotely, did that affect the tissue of your team? And could you please answer that in French, please? Comment ça a changé rapidement en 1 minute?
Avec plaisir, puis merci de le demander qu'on réponde à la question en français. Moi, ça m'inquiétait. On est une équipe la façon que l'équipe a été bâtie, c'est toujours d'ajouter quelqu'un qui pense différemment de moi. Fait que l'idée, c'est de regarder toujours une réalité d'investissement avec plein de perspectives et ça ajoute énormément de valeur. C'est comme ça que l'équipe a été montée. Fait que toute mon équipe a une diversification en termes de background éducationnel, en termes d'expérience de travail, en termes de pays d'origine, et ça ajoute énormément de valeur. Et ce qu'on aime, c'est justement se retrouver ensemble, faire des brainstorms ensemble, discuter de plein d'idées, discuter de qu'est-ce qu'on est capable qu'est-ce qu'on apprécie en termes de ESG, qu'est-ce qui est correct dans notre vente. Et les brainstorms, évidemment, chaque analyste a une expertise sectorielle, les marchés sont trop efficaces pour faire ça. Mais c'est intéressant d'avoir une analyse qui couvre l'énergie, avoir une opinion sur Starbucks, par exemple. L'opinion, ça va être, mais comment ça se fait qu'il n'y a pas une OPEC pour le café? Il y a peu de terre arable où pousse le café. Et donc, les interactions de l'équipe sont hyper importantes. Et j'avais vraiment peur que quand tout le monde est retranché dans son coin, qu'on se parle par écran, que ça nuise. Mais non, on continue à avoir du fun, on continue à rire. On a un appel chaque matin à 8h15 qui nous amène à peu près un petit peu avant 9h, peut-être 9h15, 9h. On a un appel à chaque jour à 3h. Fait que ça, c'est tout le monde ensemble. Tout le monde a fait ses devoirs avant chaque appel. Donc, on arrive vraiment à travers Teams à garder les étincelles. L'idée, c'est d'avoir, pour qu'une équipe, pour que les étincelles qui volent fassent en sorte que l'équipe agrégée soit plus grande que chacune de ses parties. Et moi, j'avais peur que les idées circulent moins vite, que les étincelles soient pas là. Mais non, on se regarde la face, puis ça continue à aller super bien.
Il semblerait que la performance a quand même bien fait, donc j'imagine que la distance ne vous a pas nui. Et bien sûr, ça revient à la thématique qu'on a parlé tout à l'heure, la technologie est là pour rester. On l'a vu, ça a changé bien des choses. Mais quand on l'utilise bien, je pense que ça a un impact très positif. J'aimerais ça avoir beaucoup plus de temps. It's already been an hour and I want to respect and stick by our hours. So j'aimerais remercier tous les gens qui ont participé, les gens qui sont francophones. Thank you for all of you guys in Canada, in the US, and outside of the country. I know we have a long list of people who watched us. Merci, Jean-David. Thanks for spending the time. I wish we could have answered more questions, but unfortunately, we're running out of time. And on this, we'll probably reconvene at a later stage in probably 3 months' time and try to give you another summary of Jean-David's investment in global ex-fossil fuel, and US funds. These are 3 funds that Jean-David and his team are managing. So again, thank you very much and have a very good day. Merci.
Thanks, everyone.